In a very long career on Wall Street, over half a century, he saw everything, including the worst stock market crash in history. Experience is the best teacher, and he had more of it than just about anybody who's ever worked in the investment business.
Part 2 of our interview with Jason Zweig, editor of the just published 75th anniversary edition, is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Wealth Track's founding objective 20 years ago was to help our audience build financial security to last a lifetime through disciplined, long-term diversified investing. We have been guided in that quest by investors with proven long-term track records and financial thought leaders. Well, many of our guests follow the principles and teaching of Benjamin Graham, considered to be the father of value investing. A brilliant investor himself, his book, The Intelligent Investor, published in 1949, is still considered by none other than Warren Buffett to be by far the best book on investing ever written. A new edition of the book was just published, celebrating its 75th anniversary, an event so noteworthy that we are devoting 2 programs to it. For the second week in a row, its editor, Jason Zweig, is our guest. You can see part 1 of our interview on wealthtrack.com. Zweig is an award-winning financial journalist who has written the must-read and aptly titled The Intelligent Investor column at the Wall Street Journal since 2008. He is also the author of several books of his own, including Your Money and Your Brain, one of the first books to explore the neuroscience of investing, and The Devil's Financial Dictionary, a satirical glossary of Wall Street. Zweig updated the last version of Graham's The Intelligent Investor in 2003, and as he did then, he has left Graham's text virtually unchanged. What he has done is, chapter by chapter, added new commentary to put Graham's time-tested investment principles in 21st century perspective. I asked Zweig to elaborate on Graham's groundbreaking theory that the worst enemy an investor faces is himself.
I think it was based partly in his own experience and partly in his profound understanding of human nature. He was a philosopher, he was a psychologist, and he was an incredible observer of markets and human behavior. I think of all the great investors I've interviewed over the years, and they all tell a story about their own fallibility or stupidity. Charlie Munger talks about not buying Walmart. Harry Markowitz, who won the Nobel Prize for inventing the modern theory of portfolio diversification, admitted to me that when he was trying to decide how to diversify, he flipped a coin and went 50-50. So, I mean, it's, of course we're all our own worst enemies. And I think what Graham would add if he were here today is that the most common way today that people become their own worst enemy is by giving up their sense of self. The great Danish philosopher Kierkegaard said something like the easiest and most tragic thing in the world is to lose your own self. And most of us underestimate how easy that is.
Right.
And then people get swept away by the crowd. Suddenly everybody is buying GameStop. And so what do? I go buy it too. What is GameStop? I don't know. It's something and it's going up. And then, people lose 90% of their money doing that, and they blame everybody else instead of arguably what they should be doing, which is looking in the mirror.
What you're talking about, these really profound observations that Benjamin Graham had about individual psychology, and this was like way before behavioral finance. Where did he get these ideas and these observations from?
I would make a strong case that Graham was one of the most brilliant people of the 20th century in any field. He was admitted to college at age 17 only because Columbia, where he went to college, lost his paperwork when he was 16. Otherwise, he would have started college at the age of 16. He graduated in 2.5 years, and he was salutatorian of his college class. And before graduation, he was offered faculty positions in 3 different departments: English, philosophy, and mathematics. He was fluent in ancient Greek and Latin and probably a half dozen European languages. He held 2 U.S. patents. He wrote an article in the American Mathematical Monthly when he was 23 years old. He was incredibly smart, but he also was very observant about how ordinary people behaved. He had been through market bubbles and market crashes, and he, in a very long career on Wall Street, over half a century, he saw everything, including the worst stock market crash in history. Experience is the best teacher, and he had more of it than just about anybody who's ever worked in the investment business.
Jason, what's interesting is that with Ben Graham's really broad intellectual capabilities and interests, that he chose to focus on finance.
He strongly considered becoming a professor at Columbia, but he had to support his widowed mother. And the dean said, you should go work on Wall Street. So he did. And then later in his life, he came back and he became a professor at Columbia.
Right.
What several people have told me is that Graham wasn't interested in making money. He was interested in understanding money. He found the psychological puzzles endlessly fascinating, but he wasn't out to build the biggest pile of dollar bills. He was more interested in what it told us about the human condition.
And for those viewers who have not seen our first interview on The Intelligent Investor, just give us a quick summary of who is the intelligent investor? What are the characteristics of the intelligent investor?
Yeah, Graham was very clear about this. He didn't mean the conventional definition of intelligence, which is, how smart you are, how high a score you have on an IQ test, or whether you have a graduate degree. What he meant was, do you have good judgment? Are you skeptical? Can you think independently? Are you open-minded? Do you understand the basic principles of analyzing data? And you don't have to be a mathematician. You just have to have common sense and not be swayed by what the crowd might think or what you believe will get you status. And that definition of intelligence is really useful, but it also corresponds very closely to how most people would define wisdom. And so I think Graham would laugh at the term smart money that we so often use to describe professional investors who underperform the market. And he would say that you shouldn't aspire to be the smart money. You should aspire to be the wise money.
And wisdom means that you stand apart from the crowd. So it can be a lonely pursuit, right?
What I see is that so many investors are trying to get good at things that are bad for them. I see people trying to trade zero-date call options. I see people trying to day trade. I see people, trading foreign exchange and trying all kinds of stunts and gimmicks, a lot of which you supposedly have to be trained to do, when in fact they could just pause and ask themselves, what are my long-term goals? And how would this actually help me get there? Is there data suggesting that other people who have done this have succeeded at it in the long run? And would an objective observer tell me that this is actually a good idea? And I think if more people asked questions like those, which Graham would encourage, fewer people would try doing things that are bad for them.
One of the things that we talked about in the previous interview was how difficult it is to be an intelligent investor now versus what it was 75 years ago when Benjamin Graham first published The Intelligent Investor.
It isn't just harder to be an intelligent investor than it was 75 years ago. It's harder to be an intelligent investor than it was 75 months ago. Smartphones are universal now. Most people, I think, have a brokerage app on their phone. Virtually everyone is on social media, whether it's Twitter or Instagram, you name it. What is social media about? It's about comparing yourself with other people. And that's the kiss of death for an investor. Why would you want to compare yourself against millions of strangers? Who cares how they're doing? Furthermore, most of them are lying. They're bragging about these big gains they made. You have no proof that they actually made them. They're not telling you about the money they lost, and you're going to be envious and jealous of them. I think that's crazy, and I think Graham would really admonish people, turn off your phone, get off social media, go for a walk in the woods, listen to some good music, unplug from the tidal wave of information and noise and competition, and just think about, what are you trying to do as an investor, and how can you get better at that? And how can you maximize the odds that 5 years or 10 or 20 or 30 or 50, you will have achieved your financial goals? And the chances are that has nothing to do with what the crowd is telling you to do on social media.
You actually tested a popular trading platform. What was your experience like?
Well, a lot of these apps are deliberately designed with interfaces that are intended to mimic what you see when you sit down in front of a slot machine in a casino. The stock prices actually roll just like the lines, the spools on a slot machine. And you get all these bright colors, you get flashy noises, you might get confetti when you score a hit. All of those things are designed to hook you. I'm the kind of person who can walk from one end of a casino to another and never be tempted to sit down at a slot machine or walk up to a gaming table or participate at all. I just lean against a wall and watch what other people are doing. And I've always been immune to that. But when the casino was in the palm of my hand, the dynamic really changed.
Wow.
I would describe what happened to me as temporary addiction. I could not put my phone down. I couldn't stop trading. I traded dozens of times over the course of a few days. And the worse I did, the more desperate I became to do better. And I tried everything and nothing worked. And I ended up losing pretty much all the money that my expense account, thank you, Wall Street Journal, had allowed me to put in. And it was a disaster. And I think if you don't control those impulses, it can really lead you astray and put you in a very difficult situation.
So it's like a drug.
It's like a drug.
And to hear that from you is pretty astonishing. How do you avoid getting caught up in the vortex of this trading frenzy that we are being enticed to participate in?
So again, it's all about structure, Consuelo. I think every investor should start with something called an investment policy statement, and it lays out the basic principles of what you're doing. What is this money for? How will I measure success? What is my investment time horizon? Which forms of investments are suitable for me to use to achieve those goals? How often should I trade? What procedures do I have to follow before I buy or sell any investment? And specifically, how often will I measure whether I'm on track? And what will I do about it if I'm not? That's the first step. But then there's really simple practical steps you can do. One I really like is, if the market is open, your account should be closed. Don't trade during market hours. It forces you to take your eyes off the motion of stock prices and deal with the market when it's flat. Nothing is moving. And that prevents you from getting distracted by whatever is going up or down the most, and will help you be more objective about your decision making. And then you need to run everything you do through a checklist that forces you to take specific steps before you can take actual action. And if you combine a bunch of principles like that, you've put structure around your decisions, and it helps you prevent making impulsive choices that can hurt you.
What kind of a checklist?
So a good checklist would include things like, if you're buying individual stocks or ETFs for that matter, would be, have I read the annual report, the quarterly reports? If it's a fund, have I looked at all its holdings? Do I understand where its exposures are? Have I checked what the expenses are? Again, if it's an individual stock, have I read the proxy statement? Is the management fairly compensated? Are people being paid too much in stock options? You would also want to test the products if it's a company. You would want to think about who the up-and-coming competition is, who the biggest customers are, and you should ask yourself, why is this a good business? If this business raised its prices, would all its customers walk away, or would they stay? 5 years from now, will this be a better business than it is today, and why? And simply by forcing yourself to go through that checklist, you will put a barrier between you and your impulses. And you still can make mistakes. In fact, professional investors, almost all of whom will rely on a checklist in some form or another, make mistakes all the time. But you'll make fewer mistakes. But the key thing is, you'll be able to learn from your mistakes. Because if you invest on whims and hunches, you can't learn where you went wrong. But if you follow a checklist, you can then see, what did I get wrong in my process? What did I misinterpret? What did I forget to ask? What did I put too much reliance on? Were there other sources I should have consulted to make sure I was correct? And the more structure you put around a decision, the easier it is to learn from it in hindsight and improve your process as you keep investing to go forward.
So those are for individual stock investments. Help us apply this kind of investment hygiene to where most of us are investing, which is in index funds. We've got these sector ETFs. We've got factors that we can invest in, like momentum or value. How do we apply these kind of intelligent investment rules to that reality of index funds and ETFs?
If your money is in very broad-based index funds, like a total stock market index fund or an S&P 500 index fund or a total international stock index fund, you probably don't need a detailed checklist, but you still need one. And I think the first question you would have on it is, do I have the right amount of money allocated to this fund? Do you want to have 100% of your money in a stock index fund? You might if you're very young and you understand the risks you're taking and you can afford to be wrong. But you want to make that decision deliberately, not by default, or because you just didn't think about it. And then the second thing, which would apply to narrower index funds, maybe ones that invest in factors like momentum or value or quality or some of the other smart beta funds that are out there, is you would want to look at when does this kind of fund do poorly, and how does that correlate with the kinds of risks I might have in my own life. Because it's really important for investors to realize that you have several different forms of capital that constitute your total wealth. And your financial capital, the money you invest, is only one of those forms of capital. You also have human capital, which is the value of your job and your career. And if, for example, you work in finance, maybe you sell insurance, maybe you work at a bank, maybe you're a financial advisor. If you work in finance, I don't think you should own a finance sector fund, because if we get something like the 2008-2009 financial crisis again, and bank stocks and other financial stocks go down 50, 60, 70, 80% or more, then your financial sector fund will be down at the same time that your job prospects may just have turned very dark. So you want to have all those things on your dashboard. And I think if you work with a good financial advisor, that person can help you think some of these things through.
Jason, one investment for a long-term diversified portfolio, what would it be?
I think what I would urge people to do, Consuelo, is to widen their peripheral vision when they think about their portfolios. And what I would urge people to do is think of your wealth in several buckets and try, as you go through your investing career, to fill all those buckets as full as you can. So you have your financial capital, which is your cash and your stocks and your bonds and your mutual funds and ETFs. But that's not your only set of assets. You also have physical capital, which would be your house and any other real possessions you have, your car, your second home, your boat. Maybe you own collectibles or antiques or art. And then, of course, there's your human capital, which is the value of your career and your job. And you should, at every step of the way, be seeking to make the most of all three of those buckets and also to make them work well together. And I think that's very often overlooked, not just by individual investors, but even by many financial advisors. And people often have enormous sources of wealth that they don't even factor into their thinking, while other people have potential to increase those other sources of wealth, but spend too much time thinking only about their financial capital. And you could, for example, go back to school, get another degree. You could moonlight, and you can take an enormous proportion of any income you get in a second job and put it into something like a SEP IRA or other retirement account that gives you a lot more flexibility for saving for the future.
Jason Zweig, thank you so much for joining us on Wealth Track, and congratulations on the 75th anniversary of The Intelligent Investor and editing that wonderful classic book. So thank you, Jason.
Yep. Thank you, Consuelo. It's great to be with you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is protect yourself from market madness. As Benjamin Graham wrote in The Intelligent Investor, the investor's chief problem and even his worst enemy is likely to be himself. Graham talked about independence of thought and action as the basic advantage of the intelligent investor. Unlike professional investors, individuals are not under pressure to outperform peers or the markets. Our time frame is infinite. We don't have to justify our investments. We can buy when Mr. Market is miserable and sell when he is euphoric. but that takes discipline and independence of thought and deed. Zweig recommends constructing investor hygiene structures, a series of rules, policies, and procedures that you must follow before making any investment decision. No exceptions allowed. Like the Greek myths of sirens luring sailors to their death with their enchanting songs, the market's lure is powerful. Do whatever you can to block out the noise. Next week, we'll have the first of a two-part interview on how to retire with Morningstar's personal finance guru, Christine Benz, and our focus will be on the important but often neglected non-financial aspects of retirement. In this week's extra feature, Jason recommends some of his favorite books to help you on your journey to become an intelligent investor. Please follow us on Facebook, X, and our YouTube channel. Thanks for watching. Have a super weekend, a happy Thanksgiving celebration, and make the week ahead a healthy, profitable, and productive one.